Welcome back to the deep dive. For years, we've covered, the mechanics of building wealth, the accumulation phase of financial independence, retire early.
Hmm.
We've talked about savings rates, investment vehicles, and portfolio growth. But while accumulation is hard work, it generally follows a pretty simple playbook. Save, invest, repeat.
That's right. And everyone loves that part of the story, watching the portfolio balloon. It's the glamorous, the outward-facing part of the journey. But the true financial engineering challenge, the ultimate stress test of your planning, happens when the growth stops and the spending begins.
Exactly. We're talking about the exit strategy. And this is the most complex, the most error-prone phase of the entire journey.
It really is.
It's that critical few years, often a decade or even more, between leaving your traditional job and turning 65. That's when the financial safety nets of, say, Medicare and Social Security, particularly here in the U.S., finally become available.
Right. And in that gap, you are entirely on your own. It's a bridge period. And the mechanics of that transition are, frankly, unforgiving.
So our mission today is to architect that bridge. We are synthesizing material from three really disparate but essential sources.
Yeah, first, we've got rigorous academic financial models that really dissect the true math behind safe withdrawal rates.
Then second, highly specific community discussions. And these reveal the surprising and honestly brutal tax implications of navigating U.S. healthcare subsidies.
And finally, a deep sociological look at the philosophical difference between the life you are escaping and the life you are building. It's the motivation that underpins the whole thing.
We are moving past the simple 4% rule of thumb today. We're diving into sophisticated portfolio decumulation, the art of controlling your taxable income down to the last dollar, and the deep intrinsic motivations that allow you to stick to such a rigid plan.
We're giving you the shortcut, the full briefing on the exit strategy for 2026 and beyond.
Let's start with the hard math, because at the end of the day, everything hinges on knowing exactly how much you can spend without running out of money.
Right. The core problem of retirement planning really boils down to two sides of the same coin.
Okay.
Fundamentally, you're asking one of two inverse questions. One, given the consumption, let's call it C, you desire, how much wealth, W, do you actually need to achieve it?
And the other side.
Two, given the wealth you currently have, W, how high can your annual consumption, C, safely be?
And since we intuitively know that if you double your savings, you should be able to, roughly double your sustainable spending, the whole exercise is about calculating the precise ratio between consumption and wealth.
Exactly. That ratio, C divided by W, is what we all call the safe withdrawal rate.
And for decades, the standard answer has just been the 4% rule. It's a beautifully simple rule of thumb.
It is, but when you strip away the rule and look at the underlying financial modeling, you quickly realize why being conservative is so essential, and why focusing only on average returns is, well, it's a dangerous trap.
Okay, so let's unpack this using the academic models we synthesized. If you begin to calculate the ideal first period withdrawal rate, you start by modeling retirement wealth against consumption, assuming that consumption grows with inflation.
Right. Now, if you make a major mathematical simplification, and it's one that a lot of hopeful fire planners try to make, and you only plug in the historical average return of the market, but you completely ignore the volatility, the daily ups and downs.
And the numbers look very appealing, I'm guessing.
They look fantastic.
Yeah.
If you assume a typical 30-year retirement period and you plug in historically sound figures, say an 8.2% average compounded return and maybe a 2.9% consumption growth rate, but you treat the market as a smooth, predictable escalator, the model suggests a withdrawal rate that is dangerously high.
How high are we talking?
It comes out around 6.3% for the first year.
Wow, that is a massive difference from the traditional 4% or even a slightly more aggressive 4.5% rate.
It is. But that 6.3% withdrawal rate is mathematically sound only if your market returns arrive smoothly and predictably every single year.
Which brings us to the critical insight. That 6.3% is an unduly aggressive rate because markets just don't work like that. They crash, they soar, they dip.
They're stochastic. They're governed by randomness.
Yeah.
And the academic research confirms that the moment you introduce the variance in returns, what we call market volatility, the measure of those wild swings we see day to day, that realistic risk instantly drives the safe withdrawal rate way down.
And this is the financial concept known as sequence of returns risk, or SRR, which is the true killer of early retirement plans.
Absolutely.
You could have a 30-year average return of 8%, but if a major crash hits in year 1 or 2 of your retirement, you are forced to sell a huge percentage of a severely depressed portfolio just to pay your bills.
Think about it. If you're withdrawing 6.3% and your portfolio drops 20% in the first year, you just went from drawing 6.3% to drawing nearly 8% of your remaining balance, all while the market is struggling to recover.
That portfolio might never have a chance to catch up.
It often doesn't. That initial draw can be fatal. So the inclusion of realistic volatility in the model is precisely what validates the conservative 4% rule of thumb. It pulls the rate down into that safer 4.0% to 4.5% range.
So it's not just the average return that matters. The market's unpredictability is, mathematically speaking, almost as significant as the growth itself.
That's a great way to put it. The risk of the swings is just as important as the average climb.
This rigorous modeling also provides a really fascinating answer to the question of longevity risk, that deep fear that you'll simply outlive your money.
The long view. Yeah, let's talk about the idea of retiring forever.
Mathematically, this is represented by letting the time horizon go to infinity. It sounds impossible, but the intuition is actually pretty solid.
And the math confirms it. Perpetual retirement is possible. What matters is the real return of your portfolio, the return you get after factoring in both inflation and the cost of your consumption growth. If your consistent, modest real returns remain positive, supporting perpetual spending, then the equation holds true. You can, in theory, spend forever.
So this means that if you can live off the growth your assets generate above inflation, you essentially have a permanent endowment.
Exactly. It's an elegant proof that consistent, modest consumption, coupled with a disciplined use of growth assets, can defeat that fear of outliving your money.
And to really stress the absolute necessity of those growth assets, the sources presented a great thought experiment.
The cash versus stocks idea.
Right. So imagine a scenario where you choose to minimize risk by holding an all-cash portfolio. Your consumption is flat, let's just say no inflation, and your assets return absolutely nothing.
Well, if your retirement is supposed to last 30 years, you are forced to simply divide your portfolio by 30. Your withdrawal rate is just 1 divided by T, or 3.33%.
And you are guaranteeing you will run out of money at year 30. Day 1 of year 31, the account is empty.
Precisely. This highlights the core problem. You need market returns, specifically from growth assets like stocks, to compensate for inflation and to overcome the necessity of drawing down your principal so quickly.
Without those returns, you'd have to withdraw even less than 4% just to last 30 years, let alone forever.
And, when planners rely on historical data for this, they often use what's most conveniently available. Recent data from modern exchange-traded funds, or ETFs.
But the sources highlight a major methodological issue here. ETFs are relatively young. Most of them are less than 35 years old.
And if you rely only on that recent data, you get a really skewed picture of history. The study we looked at compared the long course data set from Schiller, which goes all the way back to 1871, against the post-2007 ETF data.
And what did they find?
They found that recent returns systematically differed from the very long-term historical averages. U.S. equities in particular have shown higher returns, but often with more variability recently, while bonds have shown much, much lower returns than their long-term historical norms.
So, relying solely on the market performance of the last 10 or 15 years, a period heavily dominated by low interest rates and massive tech growth, to plan a 60-year FIRE timeline is it's dangerous.
It's recency bias in action. You have to use the longer, albeit coarser, dataset to adequately model volatility and ensure safety across various, very different economic regimes.
Okay, so now let's move to a strategy that is definitely high risk, high reward, and I think we need to say this is only suitable for the truly sophisticated.
We're talking about advanced portfolio optimization using leverage.
This sounds completely counterintuitive to the principles of safe retirement planning. The sources are suggesting that borrowing money to invest can enable a significantly higher rate of consumption while, surprisingly, reducing the risk of outright portfolio bankruptcy. How does that make any sense?
It flips the traditional risk calculation on its head. By leveraging, you increase the expected returns of the portfolio dramatically. The backtesting simulation showed that for levered majority equities portfolios, they could deliver withdrawal rates greater than 6.6% per year.
With low failure rates.
With low failure rates, defined as 5% or less. So on paper, this looks mathematically superior to the 4% rule.
Let's put that into dollar terms using the example of a classic portfolio. A standard unleveraged 60% stock, 40% bond portfolio might support, what, a 5.4% first-year withdrawal rate?
Something like that. But if you introduce aggressive leveraging, some of the simulations went up to 309% leverage, meaning for every dollar of your own equity, you borrow two more. That strategy could enable an 8.2% first-year withdrawal rate.
An 8.2% withdrawal. That's a massive, potentially life-changing increase in annual spending.
It is.
But wait a second. If the 4% rule is conservative specifically because of sequence of returns risk, isn't suggesting an 8.2% withdrawal rate with leverage simply irresponsible for 99% of people? That feels like gambling your retirement.
It is absolutely gambling for the unprepared. And the caveat here is vital. Leverage fundamentally changes the failure criterion.
Okay, how so?
You're no longer waiting for your portfolio to slowly dwindle to zero, which is the standard definition of bankruptcy for an unleveraged fire plan.
Instead, the catastrophic risk is a sudden, sharp market drop.
Yes. The failure point shifts to triggering a margin call. If you are 300% leveraged, a market dip of just 25% could potentially wipe out 75% of your equity, instantly triggering a forced liquidation by your breaker.
And the sources noted this actually happened in the simulations.
It did. This failure mechanism, the forced sale of assets due to margin calls, occurred in 2% to 3% of simulations, depending on the specific leverage ratio.
So you trade a slow, painful death for a fast, catastrophic one.
That's a perfect way to describe it. The math may show higher consumption is possible, but the personal finance reality is that you must have perfect execution and nerves of steel to manage that margin. It requires constant monitoring, potentially adding cash to the margin account during market stress.
It's purely a theoretical optimization for the vast majority of early retirees who are, seeking peace of mind.
Precisely. It's an intellectual exercise showing how capital efficiency can be maximized, but it introduces an abrupt and non-recoverable mechanism of failure. The conservative 4% rule is essentially a trade-off. You sacrifice 1% to 2% of potential annual spending for near-certain peace of mind against the catastrophe of a margin call, or SRR.
All right, let's shift gears from the mathematical volatility of the market to the regulatory and cost volatility of the healthcare system. For early retirees in the U.S., the cost of healthcare between retirement and age 65, when Medicare provides that relief, is often the single most dominant, unpredictable factor.
It completely changes the focus of your planning.
Yeah.
During accumulation, you focus on portfolio growth. During the early retirement bridge, you focus entirely on strategic income management.
And the linchpin here is the Affordable Care Act, or ACA, and the crucial subsidies available through it. These subsidies are determined by your household's modified adjusted gross income, MAGI.
MAGI management becomes the single planning imperative, and the common wisdom you hear is just to keep your MGI below 400% of the federal poverty level, or FPL.
Which is around $55,000 for a single filer today, give or take.
Right, but this common wisdom is dangerously simplistic. The sources we reviewed reveal a level of tax complexity that requires, surgical, precise execution.
The crucial discovery is that the ACA subsidy mechanism does not behave like traditional federal tax brackets, which most people understand intuitively.
Right. In a traditional bracket, if the 22% bracket starts at, say, $40,000, you pay 22% only on the income you earn above $40,000. All the money below that threshold is taxed at the lower previous rate. Simple.
But the ACA is non-linear and much more punitive.
That's the key. For the ACA calculation, if you cross certain income thresholds, every dollar you earn increases the premium percentage taken from all previous dollars within that income band.
It's not a step, it's a cliff. A nonlinear cliff that creates these sudden, steep spikes in your overall costs.
Exactly. This is where we introduce the concept of the effective marginal tax rate, or EMTR. This is your combined federal income tax rate plus the implied tax you pay from losing the ACA subsidy.
So what did the sources show? How bad can it get?
The sources show that once a single filer's MGI went just a little bit past $25,000, their combined EMTR could spike violently beyond 20%.
And the truly shocking number, for an optimized early retiree who has a large 401k balance they need to pull from, the last dollar of withdrawal could be taxed at a whopping 30%.
And let's be clear, that 30% isn't just federal income tax.
No, it's the cost of federal income tax plus the loss of thousands of dollars in ACA premium subsidies.
It completely breaks the traditional fire wisdom. The old advice was always, save pre-tax now, pay a low tax rate later.
But if later means a 30% combined tax rate because of this subsidy loss, that entire equation just falls apart. You paid a low tax rate in your high earning years only to pay an equally high effective rate in your low earning years.
And that's just dealing with the premiums.
Hmm.
Even more catastrophic are the cost-sharing reduction CSR cliffs. This is where the planning has to be absolutely meticulous.
Okay, walk us through CSRs because they affect the actual risk profile of your retirement budget, not just the monthly premium cost.
CSRs are fantastic. They are tiers of subsidies that reduce your non-premium costs. So your deductibles, your copays, and most critically, your maximum out-of-pocket limit, or MOP.
So for those below 250% of the FPL, you can get plans with up to 94% actuarial value.
Right, which means the insurance covers nearly all costs. That significantly reduces the risk of a catastrophic medical event wiping out your entire cash buffer for the year.
It's a huge safety net.
Precisely. But the financial danger is the cliff associated with these CSR tiers. The FPL lines are rigid. For instance, if you jump over the 200% FPL mark, you lose a massive chunk of those cost reductions.
The anecdote shared by one planner in our sources perfectly illustrates this.
It does. Crossing a specific cliff could cause their annual MOP, the maximum they would have to pay in any given year, to jump from perhaps $6,000 to $16,000.
Let that sink in.
Yeah, think about that. You're optimizing your life, managing your withdrawals carefully, and then you realize you accidentally generated $100 too much MAGI in December. Suddenly, you have forfeited $10,000 worth of protection against medical catastrophe for the next year.
That is genuinely shocking. If that marginal increase in income, that one extra dollar of MAGI results in a cost increase of $10,000, your effective marginal tax rate is, it's exponentially over 100%.
You became financially poorer by earning more money.
It creates a zone of hypersensitivity in your planning.
And unlike the premium subsidy, which can be clawed back or reconciled later when you file your taxes, the CSR status is fixed at the point of enrollment. You can't go back and fix it if your MJI spikes later in the year. That just underscores the absolute necessity of accurate, controlled MIJI estimation.
This environment of high EMTRs and these catastrophic CSR cliffs forces a fundamental strategic pivot in asset allocation for early retirees. It's the Roth versus traditional rethink.
Right. The traditional advice holds that if you expect to be in a lower tax bracket in retirement than you were while working, you maximize pre-tax contributions, your 401k or traditional IRA.
But if your low tax bracket retirement is actually subjected to that 30% EMTR due to subsidy loss, that strategy is fundamentally flawed.
The new strategy is about tax diversification. Once you have enough pre-tax assets to strategically fill up the low federal tax bracket, say enough to generate $10,000 in MGI annually, maybe $250,000 in a pre-tax account, it becomes strategically advantageous to switch all new contributions to Roth accounts.
Because Roth withdrawals are the ultimate tool for precise MGI control. They're the clean income stream, totally invisible to the ACA calculation.
They are critical. They allow you to pull out tax-free cash to fill in the gaps without threatening your healthcare subsidies. But you need other tools, too.
Right. Generating MGI-free liquidity is the name of the game.
Exactly. Other key sources include simply drawing down cash savings, pulling the cost basis, so the original investment amount, not the gains from any taxable brokerage accounts, and using secured borrowing, like a securities-backed line of credit, which provides cash without technically generating income.
These are all indispensable levers for engineering a precise MGI in the most precarious years of early retirement.
To make this hyper-optimization tangible, let's look at the sophisticated plan designed for Greg and Sue Smith. They're a couple targeting a significantly early exit, and their strategy incorporates all these complex rules we just discussed.
Okay. So Greg and Sue aim to retire at age 57.5, which is notably before the standard penalty-free withdrawal age of 59.5.
And their goal was modest and realistic: $48,610 in today's dollars for their annual retirement income.
Their balance sheet highlights the challenge for many mid-career fire-eat adherents. They had a really heavy pre-tax lien. They had over $563,000 in tax-deferred assets, but only about $87,000 in tax-free assets at the start of the plan.
So they had a massive tax problem looming right in the middle of their ACA bridge years.
So what did they do?
First, they needed to maximize growth quickly to hit their calculated target of just over $1 million in consumable assets. To do this, their pre-retirement asset allocation was highly aggressive: 90% stocks, with only 5% allocated to bonds and 5% to cash. This was their final aggressive push before the transition.
And once they hit that distribution start, the plan immediately shifted to preservation mode.
Right. The allocation eased off to 72% stocks, 21% bonds, and 7% cash. They went from maximizing growth to prioritizing income stability and capital preservation against that sequence of returns risk we talked about.
But the most impressive part to me is their strategy for navigating the penalty avoidance period, that 57.5 to 59.5 window, where early withdrawals usually incur a 10% penalty from the IRS. They needed a layered approach.
Layer 1, the age 55 rule. This is the first easiest bridge to cross.
Absolutely. Because Greg and Sue separated from their employer in or after the calendar year they turned 55, they gained immediate penalty-free access to funds within their former employer's plans, their 401ks.
That specific rule allowed them to immediately allocate over $500,000 of employer-sponsored assets for consumption between age 55 and 59.5 without paying that 10% penalty.
That rule alone is often the catalyst that makes early retirement possible for those with high pre-tax savings. But what about the remaining IRA balances? Those don't qualify for the age 55 rule.
Right, and that requires the second layer, the Roth conversion ladder. Since they had to manage their MGI precisely to maintain their ACA subsidies, the plan utilized Roth conversions.
Okay, so they're strategically moving pre-tax money into a Roth IRA.
Right, they pay the tax on it now at a carefully controlled, low marginal rate, and then those converted funds become available for penalty-free withdrawal 5 years later.
So they are using the Roth conversion not just for tax diversification, but as a systematic way to generate penalty-free income during that crucial pre-59.5 window.
Precisely. They are funding their future cash needs with intentionally taxable income today while maintaining their MGI below the catastrophic CSR cliffs. It's brilliant.
And what if they needed access to a larger pool of IRA funds immediately, before that 5-year ladder matured? That's where the third tool comes in, the 72 exception.
Since substantially equal periodic payments, or SAP, this is the third safety valve for accessing IRA funds early. It's an IRS-approved method, but it's highly rigid. Once they start a 72 distribution plan, they must maintain that fixed calculated distribution schedule for 5 full years or until they reach 59.5, whichever is longer. No changes allowed.
That rigidity can be a double-edged sword. It guarantees penalty-free access, but it completely eliminates flexibility, which is often the entire point of FIRE.
Right. If they decide they want to travel less for a year and lower their spending, they can't. They must stick to the calculated payment.
So it demands rigid adherence. That's why the plan prioritizes the age 55 money and the Roth ladder first. They offer more flexibility and ANGI control. The 72T is reserved for situations where taxable assets or the ladder just can't meet the spending needs.
Looking at their long-term forecast, the cost of healthcare in that early phase stands out dramatically.
It really does. The plan explicitly details the jump in expected costs. It lists subsidized healthcare premiums for 8 years, right up until Greg is Medicare eligible. But look at the inflation rate they applied to that specific expense.
A massive 8.00%.
That is over double the standard expected inflation rate, which they forecast at 3.10% for the rest of their living expenses. That assumption alone highlights how much risk they assign to the healthcare cost structure.
It confirms our earlier point. For early retirement, you cannot treat healthcare inflation as standard inflation. It's a separate, highly volatile, and typically inflated category that requires its own severe risk weighting, even when accounting for subsidies.
And the costs then shift again when they transition to Medicare premiums, which the plan still assumes will inflate at a high 6.00%. The cost structure just morphs dramatically as they age, requiring constant financial adaptation.
Finally, their Social Security strategy demonstrates the long-term brilliance of their MGI management.
Yeah, Greg delays taking his full Social Security benefit until age 70, and Sue delays hers until age 67. This maximizes their guaranteed inflation-adjusted income stream for the rest of their lives.
But the real planning genius is what they do before age 70. By waiting, they give themselves this wide window from 57.5 to 70 to strategically draw down and or convert their large tax-deferred savings.
So this is a preventative measure against an AGI boom later in life.
Absolutely. If they waited until their 70s to draw down the pre-tax assets, they would face massive required minimum distributions, or RMDs, which kick in around age 73. RMDs, combined with mandatory Social Security income, would inflate their MGI uncontrollably.
And that inflated MGI post-70 could trigger high-income Medicare costs, specifically the income-related monthly adjustment amounts, or IRMAA fees, on their Medicare premiums.
So they're effectively front-loading their tax liability between ages 57.5 and 70, using controlled Roth conversions and withdrawals to proactively empty those pre-tax buckets before RMDs and Social Security benefits lock them into a high-income tax bracket and high Medicare premium fees later in life.
It's a beautifully complex orchestration of tax years.
It really is.
We spent extensive time on the math and the tax architecture, which is necessary, but this intense optimization only makes sense if the psychological engine driving the plan is sound. Why do people put themselves through this level of financial rigor?
Well, the financial independence, retire early movement at its heart is a lifestyle movement. It's formally defined as seeking self-generated passive income to fund desired life choices. The sources break this motivation down into two critical categories of freedom: freedom from and freedom to.
Okay, let's start with the freedom from component. This is the rejection of the status quo, the push factors that drive people out of traditional work.
The primary push is escaping the toxicity and constraint of paid work, the ubiquitous rat race. This isn't just about hating a specific job, it's about escaping the heavy workload, the long, inflexible hours, and the pervasive anxiety and insecurity that come with relying on a single employer.
The sources shared the story of an interviewee named Anna, and her motivation wasn't purely financial, it was rooted in fear.
Yeah, Anna watched high-paid, seemingly secure relatives lose their jobs during economic downturns, which instilled this profound, deep-seated fear of reliance on extrinsic forces. For her, the FIRE strategy wasn't about leisure, it was about building a personal fortress against insecurity.
Her goal was to remove the burden of obligatory work you must do to survive, allowing her to choose if, when, and how she contributes.
The second major push is the conscious rejection of materialism and consumerism.
This is a core tenet of the movement.
Absolutely. FIRE adherents reject the social ethos that promotes continuous spending and the belief that consumers' aspirations must continuously increase alongside their income. That continuous consumption, the pursuit of having it all, is shown to lead to emotional dissatisfaction, the hedonic adaptation.
Frugality then gets reframed. It's not about deprivation.
Not at all. It's a systematic prioritization of consumption only on things that genuinely produce joy, eliminating the wasteful spending that binds people to the treadmill of work.
And finally, the freedom from consumer debt.
This is tied directly to the reliance on earned income. Easily available credit and debt obligations decrease subjective well-being. By aggressively eliminating all consumer debt, FIRE practitioners are removing the biggest constraint on their autonomy.
Okay, so if freedom from is about closing the door on insecurity, dependence, and materialism, then freedom to is the exciting aspirational half. What do people actually do once they have successfully engineered their exit?
The primary aspiration is the freedom to work on a non-monetary basis. The goal is removing the necessity of the paycheck. People don't necessarily stop working. They simply reclaim agency over their time and effort.
So this means working fewer hours, setting their own pace, pursuing passions that were previously neglected.
Or dedicating significant time to charity, volunteering, or creative endeavors. It's a pivot away from extrinsic goals, money, fame, possessions, to intrinsic goals, autonomy, competence, and connection.
Money is no longer the goal itself.
Money is redefined purely as a tool. The only limited, non-renewable resource we have is time. And money, through the lens of FIRE, simply buys back that time. It's a calculation of dollars per hour of covered life.
And this leads directly to the third factor, the freedom to pursue a more meaningful life.
The research suggests that by focusing on intrinsic needs and deliberately reducing consumption, practitioners report increased subjective well-being. This deliberate lifestyle design, which often involves simplification and prioritization, ultimately leads to the most important pull factor: financial well-being.
And financial well-being in this context is not just defined by the size of the portfolio.
No, not at all. It's defined by safety, security, and the individual freedom to make choices without economic constraints. A key element mentioned by Anna was having the capacity to absorb losses, maintaining a significant cash buffer, maybe $100,000, that ensures short-term market turbulence or unexpected medical costs don't force them back into obligatory employment.
This capacity to absorb the unexpected is the ultimate definition of freedom for the early retiree.
That's right.
We've established that a successful FIRE exit requires integrating sophisticated decumulation math, the precise control of tax and regulatory levers, and a deep philosophical clarity about your new life. It is not enough to have a large savings account. You need an operational plan for the transition.
So let's distill this into 3 concrete, actionable pillars for you, the listener, to audit your own exit strategy today.
Pillar 1. Define your AGI guardrails with surgical precision.
Do not settle for the general 400% FPL target. That is too high and too blunt of an instrument. You must identify your local federal poverty level thresholds, which change based on location and family size,
Mhm.
and pinpoint the exact MAGI level needed to maximize the highly valuable cost-sharing reductions, or CSRs.
That number, the MAGI floor below which your maximum out-of-pocket costs remain affordable, is the single most critical number in your entire early retirement budget.
Calculate that floor, understand the cost-sharing reduction cliffs, and design your withdrawal strategy around maximizing that specific healthcare benefit. Your financial life depends on staying below those catastrophic tax cliffs.
Pillar 2. Conduct a comprehensive tax diversification audit immediately.
If your retirement is heavily weighted toward tax-deferred accounts, traditional 401ks and IRAs, you have a vulnerability that will be ruthlessly exploited by the ACA subsidy phase-outs during your bridge years. You need a clean source of income that does not count toward MGI.
So we strongly suggest aggressively investigating Roth conversions now while you are still working, even if it means paying a slightly higher tax rate today.
Building that Roth conversion ladder or establishing a large balance of direct Roth contributions is the best way to ensure you have a MAGI-free withdrawal source for your crucial early retirement phase. This provides flexibility and control that no other asset type can match.
In Pillar 3, become fluent in the early withdrawal rules for pre-59.5 penalty avoidance.
You need to know which assets are accessible when. Become proficient in the age 55 rule if you're retiring from an employer-sponsored plan like a 401k to access those funds penalty-free.
If you are relying on IRAs, you must study the complex, rigid rules of the 72 SEPP plans or understand the 5-year clock associated with the Roth conversion ladder.
These penalty avoidance strategies are non-negotiable for a smooth exit. They are the foundation of your financial bridge.
Ultimately, the FIRE movement argues that less consumption, intentional living, and strategic tax planning can lead to more happiness and a more sustainable lifestyle, a double dividend of financial and psychological security.
But this entire deep dive has revealed that succeeding requires navigating an incredibly complex, high-stakes game of investment and regulatory optimization. It demands extremely high financial literacy, access to high salaries to enable aggressive savings, and precise, error-free execution.
This leaves us with a final provocative thought for you to consider. If this highly tailored, hyper-optimized path to early retirement is only accessible and beneficial to those who already possess significant financial education and high earning potential, is the retirement crisis a math problem for the individual to solve through these complex strategies? Or is it a sign of a deeper social policy failure that inevitably benefits only the privileged few who can afford the complexity of the exit strategy?
Something to ponder as you start checking those CSR cliffs and MAGI thresholds. Thank you for joining us on the deep dive.